Well, good afternoon and welcome to CJ's latest webinar, Follow the Money. I'm Peter Martin. I'm Vice President of CJ and also your chair for this afternoon. Now, we can't escape the political pressures on the hospitality sector at the moment, but today we're going to focus on finance and survival strategies, with pubs, bars, restaurants and other leisure operations facing new onerous restrictions and even more uncertainty. What will be the impact on investor sentiment, restructuring plans, and the already business casualty list? Are there any reasons for optimism? And perhaps the biggest question we want to address today is, what does a realistic survival plan look like? Now, we've brought together some great speakers, operators, investors, advisors. We've got Jana Reardon, chair of Turtle Bay Caravan and Flight Club. We've got Martin Wollstonecroft, CEO of Leeds-based Arc Inspirations, Graham Smith, Managing Director of Alex Partners, Mark Sheehan, Managing Director of Coffer Corporate Leisure, Paul Newman, Head of Leisure and Hospitality at RSM, and a late addition, and a welcome late addition, Robin Rowland, OBE, former CEO at Yo Sushi, now operating partner at Trispan, whose UK investments include Rosa's Thai and Thunderbird. He's also any non-exec at Cafe Nero and Fuller's, and probably a few I've missed, which will remind me of. So don't go away. We have an awful lot to cover today, and with people who have an awful lot to say about it as well. Now, some housekeeping points. Importantly, you can ask questions too. It's not just me, so please do. What you need to do is please write in the panel on the right of your screen, and I will pick those up throughout the afternoon. Whether that's with Carl Chesil, who'll be starting our presentation, or with any of the panelists. So let's get underway with the first of our speakers on how consumers are shaping new trading patterns. Let me welcome Carl Chesil, Retail and Food Director at CJ. Carl.
Thanks, Peter. And good afternoon, everybody. So yeah, as Peter said, I'm going to kick off with a bit of a scene setter, really.
We've just lost your screen, sir, so we can have screen share.
How's that, Peter?
I'll leave you and...
Thank you. Good stuff. It's always better when you can see the slides. So in terms of what I'm going to cover, I've done a few presentations on the road to recovery, and I've kind of renamed it really the recovery roller coaster. There's been some ups and downs, I think it's fair to say. I'm going to cover three key areas really. Firstly, changing market. So what are we seeing in terms of reopenings, performance of the sector as a whole? Secondly, looking at sentiment from a business leader perspective and also from a consumer perspective. And then finally, looking at the impacts of government policy. What's that doing in terms of the sales that we measure, and also what's it doing to consumer confidence? It's quite a lot to cover. To start with, the size and shape of the market is likely to be different as we move through this recovery phase. We're tracking this with our Market Recovery Monitor, which is now a monthly report in conjunction with Alex Partners. So these are the figures up to the end of August. We will be producing a report in the next couple of weeks. And what we've seen really is that many pubs have opened, so 91% of pubs were open at the end of August. Restaurants were slower to reopen. Many of those have gone through refinancing, are also being more selective about the sites they potentially open. We've seen some CVAs, so there's been quite a lot of activity in that sector, and generally as a collective it's been slower to reopen. When we look at late night, which has obviously been particularly hard hit by the global pandemic and the regulations, opening levels are obviously particularly low. So across the whole of the licence sector, we're at a point where around 1 in 4 licences were still to open from the end of August. And there are some differences I touched on there in terms of types of venue. There's also some regional differences. So of course we saw Scotland and Wales with different guidelines and therefore reopened slower through July. But we're now at a point where, looking at key cities, London is the particular geography that's lagging in terms of reopenings. So 10% less licenses have reopened in London versus some other key cities like Liverpool, Manchester and Birmingham. And London clearly has some structural challenges. It's really affected by lower workforce. It's affected particularly by inbound tourism and also lack of events. So some real challenges, particularly in the centre of the capital. What we don't 100% know at this point is how many licenses will reopen. So obviously we're tracking at 75% have reopened. There will inevitably be a proportion that don't reopen. We conducted some business leader research in September. So this is a survey that we do quarterly with Forth, and it's up to 200 really senior business leaders of mainly multi-site operators. And as you can see, 38% predict there will be sites that remain permanently closed across their estate. So not all sites will open, unfortunately, and on average, the people that are looking to close sites are predicting around 16% of their sites will close. So the size and shape will be different. It's not all doom and gloom though, so we are seeing operators also look to reopen, but also open new sites as well. So over 1 in 4 still have plans for openings through 2020. And some of them have been quite public about that, people like Mowgli, people like Brewdog. We've obviously seen people like various eateries list on AIM as well. So there is still activity, there is still optimism among some operators to continue to scale their businesses. We track and have tracked indeed for 10 years the performance of the sector, very much the industry benchmark with the Coffer Peach business tracker, a quick nod to both Coffer and RSM for their support on this. And what we saw as the market reopened was that on a like-for-like basis, so this is outlets that were open this year and also open last year, as the market reopened, like-for-likes were around 40% down and gradually grew through July. In August, we actually moved into positive like-for-like territory. You can see the particular spike in restaurants fueled by the Eat Out to Help Out scheme. Worth flagging though, on a like-for-like basis, we saw that positive growth, but actually total sales, so bearing in mind, as I said earlier, 1 in 5 restaurants is still closed, total sales for restaurants collectively were still down. So there's still some way to go. And obviously now that temporary boost has subsided, we have started to move into negative like-for-like territory across the different sectors, albeit some way up from where the market started. So still, I think overall, a pretty positive story for the sector. I think focusing a little bit on Eat Out to Help Out, just showing really how much that drove footfall and sales. So week 1, we saw a sort of modest spike relative to the rest of the weeks, Monday to Wednesday. Sales dipping later in the week as expected, but actually week on week, this is really interesting, momentum grew and the Monday to Wednesday spike got bigger and bigger until it pretty much reached a crescendo on the bank holiday Monday. But I think the other interesting thing from that slide is that sales for the rest of the week started to pick up and move much more close to kind of versus 12 months ago, so very much close to that kind of orange 0% like-for-like line. So actually overall a net benefit to sales undoubtedly through that period. And this has probably contributed to the research that we did, as I say, first couple of weeks of September into business confidence, that people are generally ahead of their expectations. So some of that might be relatively modest expectations that were set, but absolutely, I think, driven by Eat Out to Help Out scheme and also the skill and hard work of operators, that people have been exceeding their expectations on the whole. It's not been even geographically. So as I mentioned, openings haven't been even, but neither has performance. And we've seen inside the M25 sales lagging the rest of GB. So total sales nearly 30% down, whereas for the rest of the GB for August, they were only about 8% down from Coffer Peach. And like-for-like sales are actually up in August for outside GB, sorry, for outside M25. And some research we recently conducted for the various trade bodies, UK Hospitality, EBPA and BII, for their members. So a lot of independents covering this, quite a wide audience. You can see that 37% breaking even or making profit. So that positive August definitely helped, but you can also see some other proportions of the pie chart with people suggesting it could be 2-3 years until they start to make profit. So still undoubtedly a long way to go for many businesses. So what does that mean in terms of sentiment amongst business leaders, but also consumers? We've tracked this confidence, as I said, quarterly with Forth for many, many years now. So many of you will be familiar with this chart. We've seen the dip in optimism after the EU referendum in July 16, and then optimism takes some time, optimism in the market particular, in the orange there, to recover. It seems a long time ago, but in February we were talking about the fact that optimism had reached levels we've not seen just before that EU referendum. So sort of 83% confident in own business and 60% in the market as a whole. Now, obviously, the lockdown and what's happened in the world has significantly dented that, to understate the obvious. But we have started to see it recover a little bit. That optimism in the market is still low at the moment, still a long way to go, so a lot of support needed to ride out the current storm. But optimism in own business is at 37%. So people, bear in mind, these are larger operators, they do have plans in place, they are working hard with their teams to ensure that they can flourish long term. So I think the two things to take here is certainly versus historic norms, these are low, but some optimism in own business to hang on to. And it's particularly amongst those larger operators. So there's much more pessimism amongst smaller operators. Larger operators, I think, feeling that they have the teams and the plans in place. They also have leverage with landlords if needed. They have a voice potentially to lobby government as well. And they're also able to make choices across their estate about where they invest their time and money. Some of that privilege isn't there for some smaller operators. The sort of challenges that business leaders face, I mentioned about a storm, there's an awful lot of headwinds. Fragile consumer confidence was number one, but people looking to avoid city centres is a concern. Squeezed disposable income. I touched on tourism for London earlier, but obviously it does affect other places in the country. So coastal communities, it affects places like Bath, Edinburgh, Cambridge as well. So there's an awful lot of things to focus on. Business leaders obviously can only control what they can control. So in terms of their plans and strategy, some of them are looking to build plans to bear in mind the avoidance of city centres, looking at how they can communicate effectively with their own customers to deal with the fragile consumer confidence that's in there. But returning to the consumer confidence, that 90% figure that business leaders are concerned about and think it'll have a negative impact, it's very, very fragile at the moment. We saw consumers return to the market in reasonable numbers. From the first weekend, it was around 12%. So this is from our Brandtrack consumer research and also Pulse surveys. We've been continually tracking consumer frequency to the sector. And that grew from 12% to a point where over 2/3 of people had returned to the sector. So a real positive story, but they have started to plateau a little bit. We've seen this in the US as well. And there is undoubtedly a proportion of the population who are reluctant to go out until there is some step change, such as a vaccine. So operators, as I say, worked remarkably hard. Consumers have come back to the sector. And generally, consumers have been incredibly impressed with what operators have done and the experiences they've had. So I really like this slide. 93% have had their expectations met or bettered. So I think this is testament to the hard work operators have put in to ensure their environments are obviously clean, first and foremost. So we've been tracking this through the We Hear You campaign with Yumpingo and UK Hospitality, and consistently high scores of in-moment feedback about cleanliness, likelihood to return, particularly looking at this through August with the Eat Out to Help Out. We did see NPS drop slightly in that busy period, and I think some of that is down to venues being significantly busier, but also people starting to get a little bit fussier about their experiences. So again, with these weekly pulse surveys that we've been doing, we've been able to track some of the key drivers to the sector. And hygiene, of course, is still up there, but it's actually dropped to number 2 as a consumer driver. And things like service and atmosphere have grown from around 11th to 8th, 9th. So consumers want those memorable experiences they get in hospitality. And particularly amongst the people that have been back to the market regularly, they get a bit more fussy about what they want from their visits. And actually, business leaders understand this. So of course, ensuring staff safety is right up there, ensuring consumer safety, monitoring the various regulations. Operators are all over that, but they're also working really hard and recognise the challenge to get that balance right between experience and obviously a safe environment for staff and consumers. And generally, again, consumers are positive, as I said earlier. Their overall experience is kind of net neutral, but actually there's some difference beneath the surface. They are particularly happy with their interaction with staff. They're recognising that atmosphere in venue is perhaps not as good in net terms as it was before. I think when we've done more detailed research, that again, there's absolute understanding of that the world has changed. But certainly, I kind of watch out really that ultimately hospitality creates those great experiences, and operators get that and need to focus on that ultimately long term. And just finally around this fragility, before I move on to the next section, the concerns around second wave haven't really gone away. So again, we've consistently asked this question, and obviously it's been high profile over the last few weeks, but it's always been there in the background. And I think that's where this concern has been amongst leaders, that things can turn very quickly. And leads me neatly on to government policy and how we measure that impact, as I say, on sales, but also sentiment. And I think policy in itself obviously has an impact. So if you can only trade for certain hours, if you can only have so many people at a table, if you've got to socially distance and therefore have less covers, these all impact on sales, of course they do. But I think the rhetoric is also worth highlighting. So, we had good momentum, consumers coming back, things like the rule of 6, you can see from the headline there, that really dented the nation's collective balloon. The work from home if you can, with a 180 from people, encouraging people to work in offices. These sort of messages from government, as well as the actual rules, have an impact. And I think this demonstrates it really clearly. The Eat Out to Help Out, really positive momentum, people much more confident about going out. So a real positive government support mechanism. Actually, when we moved to the rule of 6, and we did some instant consumer research, 31% suddenly felt less confident instantly about going out. So it very, very quickly impacts frequency and consumer confidence. And again, business leaders understand that. The research we did in our business confidence survey sort of drilled into the rule of 6. And there's not a lot of green on here, not a lot of positive, as you would expect. But the kind of pinky colour of negative is across frequency, it's across September and October sales. It's up to Christmas, but I think particularly worth noting that the kind of very negative, which particularly comes up into that festive period. Big concern about it's when many operators generate big profits, or certainly profits that balance out some leaner parts of the year. And it's very, very difficult at the moment for consumers to plan for that period, to make long-term plans with the changes, and that therefore directly impacts on operators who would normally be trying to secure bookings at this period in time. And similarly, around the curfew that came in, there was a 13% net negative impact on consumer confidence. So absolutely a proportion of people that still have the same level of confidence, still want to go out. We know in the press that not everyone's aligned on the policies, whether that's consumers or even within government. But there is still a proportion of people that feel less confident when some of these messages come out of government and these new guidelines come into place. And amongst those that go out post 8 p.m, 77% are suggesting they would not go out now. So not just that they perhaps go out for a shorter period, but are not going out at all. And another proportion of people that will go out, but for a shorter period of time. So again, it will affect frequency, it'll affect how long people spend in venues, and therefore how much they spend. And we could have predicted some of the headlines and scenes we saw over the weekend. The research we did last week suggested that people post 10 p.m. would look to other places to socialise and ultimately to unregulated environments. And clearly this is a message that the sector wants to really get through to government, that having people spilling out onto the streets at 10 p.m. isn't necessarily a good idea. It's about providing safe environments for people to eat and drink, which the sector has done through this period. And just to sort of talk about lockdowns, we've been monitoring this through our managed volume pool, looking at Manchester, where a local lockdown came into place at the start of August. You can see Manchester tracking quite close performance-wise to the rest of GB until the lockdown came into place, and then the gap widened. Manchester sort of flatlined in terms of performance of sites, whereas GB continued to grow. So it just shows that there is a fundamental sales impact on venues, and with a number of local lockdowns with different guidelines in place, this is a challenge. And the curfew has also hit sales. So although the guidelines didn't come into place till Thursday, with the announcement already being out there, you can see how the messaging starts to impact sales on that Wednesday, with sales being 25% down. So there's going to be a job for the sector clearly to reassure consumers that it is safe to continue to go out, and particularly amongst bars and clubs, which understandably will be hit hardest and already hit hard by the current guidelines. Beyond that, I wanted to talk very, very quickly about financial implications. So there's obvious concern about impact of COVID on health of individuals and of their families, as you'd expect in a global health pandemic. But we've also seen concern about long-term financial implications. So people concerned about their job, particularly with the furlough scheme ending, what support they as individuals are going to have. So that also adds to the fragility of confidence. And therefore operators need more support. That's coming out very clearly in the research that we're doing. So this was a few weeks ago, so obviously the VAT has been extended for softs and food, but not obviously for alcoholic beverages. Support on rent is still something that needs resolving. So an awful lot of different points on here that still need tackling, and we may well cover some of those shortly. But if the current levels of business support were in place, and so this was a couple of weeks ago, there is a real fear, and particularly amongst independents, which a lot of this research was based on, will fail. So absolutely, to protect those businesses, support is needed. It's not quite so dire for larger businesses. There is still some risk, but our business leader research is telling us that it's a slight risk in the main, or no risk. People have access to funds. People are able to put plans into place to fundamentally to sort of ride out the storm, because this will pass. Just to summarise then, the size and shape of the market will be different. Some sites sadly won't reopen, and operators have genuine concerns, particularly amongst smaller operators. It's impossible to underplay how fragile consumer confidence is and how much it can turn very, very quickly, both positive and negative. And therefore the government policy plays a role in that, not just in limiting perhaps trading time. But I want to end on a positive, because the sector is remarkably adaptable. Hospitality has been around for generations. It will always find a way to adapt. We've already seen that over the last week or so, with people looking at how they can squeeze in extra sittings in the evening. So that innovation that's in the sector, we'll see it good long term, but that support is going to be needed. But yeah, I really want to end on that positive. The sector will adapt, because it always does. And now I'm going to hand back to Peter. Thank you.
Well, thanks, Carl. That was great. Not necessarily uplifting, but I think it does reflect where we are at the moment. We'll be coming on to our. Actually, I've just got a few. Stay with me a minute, Carl, because I've actually got some questions for you before you wander off. Actually, and that will be our next panel in a minute. Couple of questions. There's a number of questions here. Some we can pick up perhaps later. Couple on probably the future structure of the market. Got a question here from Aidan Ledger, really about occasions. It will be a lasting effect, because before lockdown we were seeing snacking on the rise. Will we see a shift back to breakfast, lunch and dinner? Do we know that yet, or are we just trying to track where people are day to day at the moment?
I think there's an element of trying to track where we are day to day, and you're right, that hopefully that there is a lot of headwinds. So from the presentation wasn't too negative, because as I say, people will adapt. I think we will see those occasions. We're starting to see it. I mean, one of the impacts we're seeing from people not being able to go to city centres is it's had a benefit really on operators in suburban locations. People being able to go out different days of the week that they perhaps haven't been able to. So we're seeing some of that, and I think operators are focusing on different day parts, and bars, which obviously have been restricted opening late, are looking at different day parts. So I think, again, the sector will adapt, consumers will adapt. Hospitality is in our DNA, so I think that we will see some subtle changes.
And a quick question here from Alison Vickers. It's really about more data we've got. Do we have a breakdown? What can we do on that breakdown of sales between sort of inner London and London villages? I know we don't get off Copper Peach, but we do get that off our trading index data, don't we? So basically, if people want to come and talk to us about that, that is available, isn't it? In fact, for some of our clients, we are putting out daily updates on certainly regionality as well, aren't we?
We are indeed, yeah, and like you say, we can get to all those breaks, but in the interest of time, and also, I've kept it as top line as I can.
Exactly. Thanks, Carl, for that. And just to remind people, Carl's presentation and a recording of the whole session will be sent to you later. And really, I do encourage people to get in touch with Carl later afterwards. And we do track all the questions, so we will get back to you as well. Carl, that was brilliant. Covered a hell of a lot of ground, and certainly giving us plenty to think about and talk about. Which brings us to our first panel, our panel of market experts. Who are going to share their views on restructuring, reimagining, how people are reimagining the industry, or perhaps simply battening down the hatches to try and get through it. So please welcome Graham Smith of Alex Partners, Mark Sheehan of Coffer Corporate Leisure, and Paul Newman of RSM. Well, we've got everybody except Mark at the moment, and we've got Mark as well. So, well, we did have briefly anyway. Technology is great. I'm sure Mark will be with us again in a minute. But actually, while we wait till you're all there, and actually, I do want to take this opportunity really to thank you guys, and particularly your companies. First of all, for Coffer Group and RSM for their long-term partnership with CGA in supporting the Coffer Peach Business Tracker, and also AlixPartners for its partnership in the production of the now monthly Market Recovery Monitor. They do allow us, ladies and gentlemen, to provide these services free to the market, so we really are appreciative of that. And it also shows commitment of these companies to the sector. Although they are also obviously busy dealing with individual companies, a lot of them in trouble at the moment. So let me start with a sort of general question where we started today. Is there any sense of optimism out there? Can we be optimistic about the future of the market going forward? Graham, how are you seeing it out there at AlixPartners? Because I know you're pretty busy at the moment.
Yeah, that's right, Peter. Clearly, there's been a lot of work that's been going on, but I think we've been going through a number of phases of this. So the initial wave, and everyone talks in waves nowadays, but the initial wave of restructurings, if you like, were really either to deal with businesses that had little headroom to survive bumps in the road as it was, perhaps due to previous challenges that they'd faced, or for those that really needed to engage with their landlords in order to recut deals which reflected the fact that their revenue line had been turned to zero, and that when it was recovering from zero, people were very unclear as to the profile of that recovery. So that's what we saw driving the predominance of turnover style rental agreements with landlords, and the provision of new money coming into these structures from their investors, but their investors wanting to put that money in knowing that the business had the flexibility in their fixed cost base to enable them to reopen in a perhaps not profitable way during the restart, but certainly in a much more sustainable way as they waited for demand to get back to more normalized levels. So that first wave was really to create that flexibility. And I think actually before the recent government intervention with regard to the rule of six and then the curfews, then I think there was reasonable optimism that had come through after a strong summer. I think the impact of customers coming back to the industry at the point where they felt it was safe, the government was essentially encouraging them to do so and providing an economic incentive to do so. But I think that gave people the confidence that actually there is a lot of pent up demand and latent demand from customers at the point where they do feel safe, and they're encouraged to return to enjoying time with their friends in hospitality venues.
Yeah, Paul, I mean, are you seeing a similar thing? I mean, are we, because of the new restrictions, do you think we're going to see more companies coming to people like you and Graham and Mark for advice in terms of restructuring, and perhaps a different sort of company? How are you seeing the market at the moment?
I think, Peter, the pipeline in terms of restructuring is pretty full, so there's probably not a huge amount more we can take on. I think what we are seeing, though, is we're seeing, as a result of this, businesses examining their business models more stringently. We're looking at deeper cuts now. I think businesses are wary of future sentiment hitting demand. So whereas you might have had a site, EBITDA level of maybe 100,000 as a viable site going forward, I think anything less than that now, operators are saying, we need to think again. And I think that's partly because of the availability of new sites on the market as well. We're seeing landlords offering much better rents going forward, of course, bigger capex contributions. So that's making operators look at their existing portfolio and probably cutting much deeper than they might have done in terms of those sites that are not viable going forward.
In terms of in terms of rental and landlords, because that's obviously been an issue and obviously been driven with CVAs as well. Mark, I mean, there are deals being done, we're seeing, and I know dealing with a number of companies as well. Are sort of new deals and structures with landlords sustainable, and are we seeing better terms coming through? Are landlords being more amenable?
I think this has been a learning process for both operators and landlords. The whole problem has gone on for much longer than anybody expected, and landlords panicked to start with, but I think they've got much closer to businesses, and they realise that they have to support the tenants to keep those sites paying the rent. We are seeing quite a number of short-term agreements with landlords. So I'm not talking about necessarily restructuring, but where tenants have gone to landlords and say, we've got an issue, we're not trading, we need some help to keep going. And landlords have been very keen to look at what the businesses have done to support themselves, as well as, and not expected to take their own pain. So landlords, I think, ideally would like to help a business survive in the short term and then come out the other end in a similar way to the landlord-tenant relationship previously. Now, with restructuring, that's very different, because a tenant will go to the landlord and try and completely renegotiate a lease or walk away from it. And there are some locations where landlords have got many tenants who are all disappearing at the same time. And it's a much more difficult conundrum to deal with than, for instance, central London, where you might have operators that are not trading now because there are or trading poorly now because there aren't many customers, but they should come back in a similar way in the future.
Let me carry on from that. We'll probably talk about the CVA. We'll go on to CVAs in a minute. What we are seeing, though, is, what we are seeing from the government is a reticence to get involved in the whole rental debate. And I think, there's a lot of people with a lot of pain, particularly smaller operators. And I think we saw it in Carl's presentation that bigger groups are feeling probably more confident because perhaps they can play more with their estate. But we are seeing turnover rents coming in, other deals. Are they sustainable? Is this a start mark of a new long-term relationship, or will landlords want to go back to the way it was before because of the way they need to value their assets?
There have been turnover rents for quite a long time. Many shopping centres have turnover rents, and generally a turnover rent works pretty well where a landlord has complete control of an estate, whether that's an estate in, say, central London or another city, or they own a centre and they pull customers into the centre and everybody works well together. So I think turnover rent will have got a part, but generally property is seen as a very low risk asset class. People pay very low yields for property because they're safe. They sign up a lease commitment, get a rent, and expect to get a small increase over a very long period of time. If that is changing, if we're looking at turnover rents or complete uncertainty over long periods of time on rental levels, property prices will have to come down substantially, because a property business would be much more akin to an operating business, which is much riskier. So you need a greater reward. I think in the short term, we will see turnover rents.
Graham, quickly, are we going to see more CVAs coming down the line? Are we going to see more companies, as it were, the Americans say, right-sizing their estates and their businesses? And is that going to make it better for investors to come into the market or support the market?
Yeah, so I think that there are still businesses that are, in discussions with their landlords. Some are able to get sufficient accommodation and flexibility to survive in their current structure. Others will still need to look to go further because they're not able to get sufficient accommodation to a consensual route and result in further CVAs and insolvencies. But just coming back to Mark's point there, or actually on the turnover rents. From my perspective, I see this very much as a transitional solution. because Mark's right in terms of what drives property prices. It is that stable fixed income yield that people look for. We're really switching to turnover rents, I think, at the moment, because of the fact that when you ask any operator what 2021 looks like at the moment, and quite frankly they'll give you scenarios, they can't give you a forecast because it's so uncertain. And in that scenario, the flexibility of turnover linked rent is really important. But actually, once you get into a more stabilized environment, typically what you'll see is if your site is performing well and you've got a turnover rent, you'll be paying more rent. So actually, even from a tenant perspective, once the market has normalized and stabilized, there's a push for them to really want to normalize this, get it onto a fixed rent. So all of the upside that they're generating is going into their pockets. So I think from my perspective, I see it's a sensible transition solution. But in the long term, I think the forces do tend to get back in more of those, if you like, normalized high street and traditional locations to more of a fixed rent structure.
Obviously, property doesn't affect everyone in the same way. Paul, I mean, looking at the companies you've been working with, or just generally across the market, I mean, what are the characteristics of a company you think is going to survive, and what are the key things that companies need to do in your view and your associates' view they need to do to make sure they can get it through this period, whether 6 months or 12 months?
Well, I think survival comes back to the strength of the balance sheet. And certainly at the start of lockdown, we saw a lot of the public companies in the sector go to shareholders to shore up their balance sheets. And those businesses that were successful going into lockdown easily attract CBILS money. And I guess what we've seen over the last few months is new investors coming into the marketplace, whether that be Towerbrook acquiring Azuri or Partners Group and Coat last week. And I'm quite encouraged by that. I'm quite encouraged that there is investor appetite still. Various eateries flotation on AIM last week. Again, that's all about not only shoring up the balance sheet, but it's about creating a platform to grow existing brands, but also to look at future opportunities in terms of acquisition. So I think there are a lot of people out there who are looking still for quality assets. The challenge is finding those assets.
So you are saying people aren't sitting on their hands, far from it. People are still looking for that longer term. I mean, are we going to see any short-term sort of openings? I think we're seeing some now, but are we realistically really looking to next year before we see any real movement in the market in terms of growth and new site openings?
Yeah, my sense is that operators are testing the market at the moment with landlords, seeing what sort of offers are available, what sort of capex contributions they can get, but very few are pressing the button at the moment. I don't think those deals are going to go away for the next 6 to 12 months.
What I mean, for all of you really, but perhaps start with Mark. I mean, what size of the market are we looking at? I mean, because there's lots of talk about how, and we don't know because of continuing restrictions and the pressures they're putting on, but what sort of size of the market are we looking at? Is it going to be significantly smaller in 6 months, 12 months time than it was pre-COVID? What's your view? Because obviously the smaller the market, the better it is for those who get through.
Yeah, I think we'd already seen a market that was contracting in the provinces in the restaurant sector with some failings. I guess it will get smaller because a lot of people will not survive. A lot of smaller units, especially the chain restaurants, will close. And as you say, that will make it easier for other operators in some of those smaller towns to survive. So if you had 5 operators 10 years ago and 20 operators 2 years ago, you might end up with 10 operators fighting for a slice of the pie. Just on the point you made regarding new openings, just quickly, I caught up with our sister company, Davis Cocker Lyons, and their agency team this morning. And quite interestingly, they're saying they're doing quite a number of deals with smaller operators who are taking advantage of fully fitted restaurants that are coming out of other operators, and they're doing quite a number of deals. And it's opportunistic, isn't it? your capex isn't 750k or 600k, it's 50k.
But yeah, sorry, I suppose the question would be what part of the world are those deals being done in as well? Because obviously city centres are pretty deserted, but the suburbs are fairly bubbly at the moment.
Yeah, I think you're absolutely right. The suburbs generally, smaller rents at sub 100,000. I think we'll have to wait a bit for some of the bigger London sites that are available to come on stream. But you know, landlords, make no mistake, they are offering generous deals to get tenants into good locations.
I mean, Graham, looking at that, I mean, what's characterised particularly the casual dining sector over the last few years is the amount of private equity investment in it. Has the appetite of private equity been diminished? Are we going to see new structures, bearing in mind perhaps we may see smaller companies? How do you see that? Or is it better to be quoted at the moment? Because actually, even today, we saw City Pubco's results come through, although they are, they're losing money, but they get positive cash flow, and they look in a particularly good position. We've seen lounges report well, M&B report well last time. Are we going to see a change in the balance? What's your view?
So I guess we shouldn't forget on the pre-COVID, what everybody was worried about in casual dining was really kind of overcapacity. It was high rental costs. It was the pressures from increasing payroll costs as well. And there's no doubt coming out of this particular crisis, then rental deals will be much more favourable. Capacity will have been taken out of the market, and I think unfortunately we will have higher levels of unemployment than when we went into the crisis. So all of those point to reduced pressure at the top line from competition, but also a reduction in the cost base. So private equity, the days of a highly levered transaction with lots of debt, and it's really the financial gearing that's driving the returns. I think that will take some time to come back, but private equity will absolutely be looking at the cyclical deal, as we've already seen with TowerBrook and Aperis, where they're buying in at what they see to be the bottom of the cycle to get a platform, potentially consolidate other players, but then also be able to open up new sites in better locations with a lower cost base. So I don't think this is the end for private equity. I think we know there's a number, looking at deals in the sector and looking at this from a cyclical play. The public markets, I think, are again a great place to be when there is the potential for high growth. And again, if you're investing at a point where the market is recovering and you've got support from your shareholders, then there is the ability to offer both cash and also equity in your business as well to shareholders that are selling out. So I think also for people who are selling, if they're not forced sellers, then they'll want to participate in some of that upside. So we may also see a return of mergers and business combinations, where actually you don't need to worry so much about the valuation in its absolute number, but more its relative value of one party merging with another, and then in the combination seeing the return in value they can share in that together.
Well, it looks like there's still some optimism that there's going to be deals to be done. Paul, last word with you. Do you think with the changing nature of the market, maybe short term, in terms of moving to suburbs or whatever, but we've seen some other structural changes like increasing use of digital. We're looking at drive-throughs, and we're looking at more delivery. Do you think investors will be looking at a different sort of operation going forward than perhaps historically they have?
For sure. I mean, that the lockdown has seen huge innovation in the sector. That topical word of pivot, is who was talking about pivoting before COVID. So I think that's been fantastic for the sector. Food service businesses in particular have been hugely innovative. But I think we are seeing a current trend outside of city centres to more regional centres where you can easily deliver a business model like that. You don't need to deliver a delivery business model or a parcel-led delivery business out of central London. So I do think we are going to see attractiveness of out of London sites come through strongly.
Well, we don't know how long the restrictions are going to go and how tough it's going to be, but looks like you guys are expecting to be kept pretty busy going into the rest of this year and going into the year. Thank you for your time, and yes, thank you for your support. And we'll catch up with you a bit later on. Ladies and gentlemen, Graham, Paul, and Mark, thanks very much.
Thank you.
Now we're now going to move on to our final panel of the day, where we're going to look probably more at the people on the front line, actually, operators and investors. So please welcome Martin Wollstonecroft, CEO of ARC Inspirations, Jane O'Riordan, Chair of Turtle Bay Caravan and Flight Club, and Roland. Welcome all. Obviously, you've heard what those guys have said. I think probably from the operators side, there's a lot of that commonality, which is a lot of commonality there with the same thing. But you're dealing with it, as I say, on the front line. The first question, I suppose, is going to be, what you're saying to investors. Martin, let's start with you. Just remind us a bit about ARC Inspirations, because although I know what you do, perhaps the audience does. So you're based up in Leeds, but you've got well, tell us what you've got.
Yeah, we've got three drive brands, Box, Mannahatta and Banyan. We've got 3 sites in Manchester, Leeds, Harrogate, York, and up to Newcastle. So it's quite topical, this, because we're having to deal with the various different local authorities' demands.
You're very much on the front line. So look, I mean, it's basically your business is you and your partner, but you've got funding. So what are you saying to your stakeholders, your banks, your people about how are you trying to keep them calm during this? Because it is, as you say, you're definitely on the front line. You're front line of lockdown at the moment.
Well, we're up, we're not in lockdown, but in terms of, I think it all starts.
You are up to all those local lockdowns all around you, aren't you?
Yeah, I think it starts ourselves as leaders, really, and it is tough. And we have to keep abreast of all the changes that are being imposed on us through the different local authority measures. And we have to really unravel all those measures in place, because it's very, very confusing. We'd have to do our best to try and understand it, see how we can apply it to the different areas that we operate in, and communicate it as best we can to our teams. And I think it's about being positive leadership from ourselves to our teams, and trying to keep our teams relaxed. This weekend was very stressful for our teams. We had the introduction of the 10 p.m. curfew, everybody wearing masks. I worked all Thursday night and Saturday night, and yeah, it's very tough for our teams out there on the front line to deal with our customers who are wearing masks. Have they got it on? Haven't they got it off? Are they trying it on? And I did a Zoom call, a video call our team via Facebook, just telling everyone just to relax. It's not the end of the world. If someone walks in without a mask on, just remind them politely, don't get into confrontation. Just as everyone leaves on time at 10 o'clock, and just trying to, I think at the moment, it's all about great leadership, reassuring our teams that, to stay calm, try and relax, don't get caught up in it too much. And in terms of, there's only myself and a business partner who own the company, so there's just 2 of us. So we speak regularly. We've carried out different cash flow forecasts, scenarios, projected P&Ls, just speaking to each other regularly, and just, I think, reassuring each other really that ourselves and our team are like coiled springs and ready to bounce back as soon as the measures change, really. So I think it's a real challenge on leadership at the moment, keeping everyone buoyant, keeping our teams communicated, and just ready to, to fire back, and just be flexible and fit to change the business to the next bloody announcement.
Yeah, indeed. Have you had to make any major changes to the nature of your business to actually see you through and, see you through to this point and then through the next few months? Yeah,
to be honest, it's been a real challenge, but quite enjoyed it. We carried out a strategic review of our business, and we've changed quite a few job roles, actually. I think the main thing was making everybody contributing in terms of the business, such as the training team department. We changed their job description, their jobs roles. So instead of as much classroom teaching, they're outside. They're in the sites. They're coaching with our teams. They're side by side with our teams, and doing a lot more coaching on site rather than being classroom based. We made 5 big changes. Some of these we've been thinking about for some while. First one was moving our payroll from weekly to monthly to give us a bit of a cash injection and help smooth out our peaks and troughs in terms of our cash. We've gone cashless across our business completely, which has been no problems at all, really. We've introduced an app, probably like most people have, but pay and order. And what's been great about that is we've got 2 sites, different ends of spectrums. We've got a site called The Box in Headingley, which is very student-led. Last few days, that's been 90% sales through an app, and also a Banyan in the Corn Exchange in Manchester, which is very retail-focused, outside opposite Selfridges, and that was 93% as well. So totally 2 different demographic groups that are buying into the app. Non-refundable deposits. I think this is something as an industry more people should have moved into. We put a spreadsheet together while we're locked down. We spent many hours debating over our sites, different time zones, different days of the week, different sites, and how much deposit, a non-refundable deposit, each customer would have to pay. So if you wanted to go to, let's say, Manhattan on Deansgate in Manchester, to make a 2-hour booking there, you'd have to pay a £30 non-refundable deposit per person. And yeah, we've done brilliant with that. We've only had 1 complaint, and we're still doing that today. So that has been massive for ourselves. And if anything, we're profiting from that, because there's quite a few people who aren't showing up. So we're making on it, rather than, I thought just after the lockdown lifted, there was something like some restaurants groups were saying 40% of no-shows. Now just thinking, we've got a great opportunity here. And I shared that information with some other chief execs, and we should have done that across the board. We've put
I'll come back in a minute. There's a lot of good practical stuff there, and I think that's the interesting thing. Because obviously, strategic review, but what you're doing on the front line. Jane, can I bring you in now? Because obviously, you're working across a number of companies, chairing boards. How you? I mean, again, remind us of what you've got. You've got as Caravan London-based, Flight Club, and Turtle Bay. How are those 3 companies coping and have changed due to the present circumstances?
Yes, obviously rather similar in some ways to some of the things that Martin mentioned. I mean, Turtle Bay, we've got 39 out of 41 open and trading. It's regional. All-day dining has benefited greatly from the sort of outside of London city centre basis. We are trading very, very strongly and positive like for like. In fact, we are probably having some of the best couple of months trading we've had ever in our history, and they have really responded incredibly well, using technology and some of the changes we've made in the business to be nimble and flexible around the changes facing us. Obviously, Caravan, we've got all 6 open and trading. They are really in the centre of London, so much more impacted, but again, benefiting from all-day trade. And whilst, maybe not where we'd like them to be, they're certainly ahead of our expectations. And then Flight Club and Electric Shuffle, we have all 7 open and trading, but obviously they're also going to be effectively capped by both sort of capacity constraints and social bubble sizing and so on, and city centre. But considering the restrictions, all trading much better than we had hoped.
So in terms of what are the sort of conversation we're having with your boards, well, the management teams, because I mean, the impression you're giving is actually they're all up for it and they're actually pretty enthusiastic. I mean, do you have to do much to keep them up, or are they naturally?
I think I've got to be pretty level-headed, because it's very easy to go into flat panic and to get into blame or put your hands in the air and say, I can't do it. All of the management teams have got a real can-do attitude, and I think we've just sort of said, okay, what's the new challenge? How are we going to respond to that? Head down, work with it. And I think get the sort of agility of responding to the constant changing world has really come out. It's been amazing how fast technology has been adopted into a sector where technology has been appalling. And I know Martin's given some good examples as well, but we've been using, in fact, in all of the businesses I'm involved in, we use very clever booking systems to manage peaks and to move people around. And the booking system itself, not only does it help prevent no-slows, but it also really helps manage your capacity throughout the day, and particularly in areas where we're being truncated at 10 p.m, to be able to move people earlier and to campaign out to sort of get people in the restaurants earlier has really helped. Not to mention the order and pay apps and the other sort of consumer apps that we've launched in the business to try and help with whether it be track or trace. I think we should all be using this opportunity to force in technology change, and that's certainly helping a lot of them.
Yeah, because I mean, you and I have spoken about that before. Now that's the opportunity, not probably what
Really,
the way that it's hoped
really
it to be, but yeah. So that's a big. Let me come on to Robin. I mean, you know, Robin, you've been a seasoned operator in your days at Yo, but now from Tri-Span's point of view, as an investor now on the private equity side, what's the perspective of private equity, and what is that relationship with? Because in a sense you're dealing with those frontline teams. What's the relationship with your investments here in the UK, sort of Thunderbird and Roses?
Okay, two very different questions. I think, you know, a good business is a good business, and if you've been around long enough, as I have and many others have, over 35 years, you'll see peaks and troughs. This is unparalleled, but a good business that still holds on to its customers and keeps a team in place and is viable is worth investing in. It has to be a bit more nimble than perhaps it used to be, and I think this thing about the provinces and the suburbs resonates with me. And I think investors who are wise are sticking closely to the businesses which they most value and looking after them. I also have a perspective on much larger businesses with Fuller's and Nero, and you know, it's the same issues even at those kind of much bigger businesses. It's a question of making sure you don't lose the DNA of the business that actually appealed to customers in the first place, but being mindful of the cash, which frankly, I think for the last 6 months, I mean, everybody was brilliant in the first 3 months of showing how quick we were as a sector in terms of controlling cash. And I suspect people think we weren't the most agile of operators, but I think the restaurant sector and pub sector has been brilliant in terms of showing they can do that. So they're not sort of blind to cash management. In the last 3 months, they've excelled in terms of what they do, which is, you know, restoring their teams and the confidence of their customers. But, you know, in terms of investment, I'm unbelievably busy this month, and I predicted September will be the month where it turns, because there are a number of businesses which are great businesses, which I think of through government support and loans, they realise that do they want to sit in the shadow of a CBIL loan for the next 2 years and just grow moss on their business, or do they actually want to move forward again? So most forward-thinking businesses are thinking about, well, I'm going to have to do a debt for equity swap of some kind to move forward again. And isn't it amazing how quick people can move their mindset? Because 3 months ago, they probably wouldn't have had that thought process, but they've got the business back up and running. So I think the juice is flowing again. Although I have to say the Peach tracker numbers, which came out while we've been on the phone, are truly horrific for last week. I'm just hoping that's just a bit of a shudder.
Very good. So, yeah.
But no, they really are shockers. I mean, people can read them themselves. But I'm more optimistic about it. And I can say we have a number of really advanced conversations with good quality businesses where there's a sense of reality coming into play, where people want to invest for the long term, and they want partners who know what they're doing. Does that
also, are there people looking at different businesses? I mean, it's the last question I asked for the last panel about in terms of types of businesses, or as it were, the characteristics of businesses. Are they going to change in terms of looking for technology, looking for multi-channel? Are they looking at other boxes to tick, which makes a company more attractive in the future than perhaps it would have been in the past?
Well, there's always that dilemma. Are you a one-trick pony, or have you got more aces up your sleeve? I think there's a danger of losing the purpose of a business if you try and be all things to all people. But I mean, you really have got to be aware of technology, delivery, moving lifestyles. Clearly, you know, all-day trading operations have won the battle on that. You know, people with fleet of foot in travel locations, small footprints, they're always very attractive. But it's not one size fits all. There are different economic models for different sized businesses. which all have relevance. But I do like what I look for in management teams, particularly, is the ability to interpret where customers might be in 5 years' time, or at least open to suggestions about how they might want to be more relevant. And if they're not relevant, you know, in a few years' time, that their whole business model is flawed. If banging out the same model year after year, I'm afraid that is not going to continue.
Right.
So being more fleet of foot. I mean, I'm sure this is preached and converted, but these are pretty obvious to all of us who are investors or seasoned operators. You have to be a lot more tuned into, you know, being more flexible. But at the end of the day, you know, if you produce an extraordinarily good quality offer at the right price, and you're consistent, and you're in the right locations, i.e. relevant, then you should succeed over time.
Yeah. Jane, bring you back in there, looking at your businesses across the piece. How has their sort of ambition changed? I mean, how are you looking at growth down the road, or are you just trying to ride out the storm as it is at the moment? You know, what's the mindset of your guys?
No, I think we are in growth mode. Definitely, we're in growth mode. Yes, we may have had to pause for the obvious reasons, but when I'm looking forward to next year, all three businesses are looking for growth. And I think there are growth opportunities out there. If your business, as Robin says, is relevant enough and on trend, then yes, we'll go back into growth in the next 12 to 18 months. And I think effectively any business plan on a recovery that is written off the basis of doing more of what we did before again is probably not going to be right. So I think you've got to have a business plan that's reflecting of the new reality and changes, and that agility that we've mentioned earlier on is important. I think all of the businesses that I'm looking at are looking at, yes, they'll stick to their knitting, but they're going to be more open in terms of their channel flexibility. We're certainly going to be more open in terms of making sure that we've used our sort of more digitally literate apps that we put in and embrace technology. And so our business plans are built off the new mindset, not just let's dust off the old mindset and just move it forward 18 months. So certainly there is a change, and it has to be a change to be believable. But I'm quite optimistic. I'm like Robin. I think there is growth out there, and actually the return for the investors, particularly those investors who can see it, and there are some of them out there that are seeing it, as we heard from the other panel. There are opportunities there, and in fact, the equity prices are going the right way, and the returns are going the right way.
I mean, you look at, say, two of your business, say Caravan, very London. It is a London business, although not completely in the middle. I mean, and Flight Club's obviously about city centres, but it's leisure. In terms of how do you see London and city centres at the moment? You know, are you taking your time on that? Will you look for new different sorts of locations, because people may not start coming back to work in our city centres anytime soon, and working from home may become a longer term trend. How is that playing out in your thinking?
Well, Flight Club is more than just London, as you know.
Yes.
It's actually now throughout the country, and in fact the growth pipeline anyway was largely outside of London for the growth pipeline. So I don't think at the moment there isn't immediate plans to open maybe more than one or two in the near future in London, and we'll more move outside. Flight Club also has a small format version which is up in Islington, which has proved to be very, very successful, and there's obviously lots of runway for that.
Yes.
For that. So yeah, and I'm fairly confident that things will come back. It won't come back hard into London soon, but they will come back into London. And Flight Club anyway is doing well at the moment, based on sort of 50-60% utilization, and still doing well. So it just goes to show that the model has great leverage, and so I think it's quite robust. And certainly in terms of a concept, it's got some long legs for the future. So I'm not so worried about that. Caravan has been traditionally only based in London. It is all-day dining though, so it has that going for it, and actually it is translatable into areas outside of London. In fact, its pipeline that it was planned to go anyway was actually outside of London. So probably we will pursue that, but we will pursue it with a little bit more agility, and certainly with a bit more flexibility in terms of channel development and the add-ons to the brand, regional and so on. Into the retail element of the brand with its coffee business.
Martin, can we talk about perhaps the alcohol food mix? Because obviously your business is really essentially started as a bar business, but you've got a food element. And what we're seeing obviously with the curfew is something which has probably come back into the market, this sort of puritanism that there's a lot of anti-alcohol sentiment out there, which is driving a lot of what we may see as irrational behaviour by the government. You know, this sense that if people are drinking, they don't socially distance, they don't obey the rules, and that perhaps could have a long-term impact on more drink-led businesses. How do you feel about that? And has actually the balance of your business changed in terms perhaps towards more food than drink?
We've got a good spread of our businesses. The Banyans, some of them are 50-50 wet to dry split, and then Manhattans are 17% food. So we've got a good spectrum there across the business in terms of a good spread. There are challenges for people to social distance, whether you are in a pub, bar or restaurant experience, and that can be from whether you're in a local pub getting towards last orders, which is now, what is it, 9:30, whether you're in a late night bar. So I'm
in quarantine. I can't go out at the moment. I just got back, so it doesn't matter.
Yeah, it's very, very challenging. But also as well is the reason why they changed the licensing law. I don't know when it was. 11 o'clock was basically stop people power drinking, moving up towards 11 o'clock, didn't it? And then buying 2 drinks at last orders and forcing it down and etc.
You guys don't, but I do. So I know how bad it was. So
yeah. So in terms of the sooner we can get back to the relaxation of the licensing laws and the stupid 10 o'clock, will be far better. And I went out last Thursday on the first night and went round, and I was out round town in Leeds with Steve Richards, and by 7:30, I was thinking, I was getting anxiety. Where am I going to get the last drink from it? Last night and stuff. It just started affecting people, and it put people on edge as well. And to get people out at 10 o'clock, at the moment, customers are not ready for it. And we saw this weekend some crazy situations, but, it was a massive case of told you so, really. So, difficult one.
Yeah. In terms of, coming to the end now, in terms of your biggest challenges from a financial point of view, Martin, what's your biggest issue? Is it landlords? Is it funding? Because obviously, I know you've got sites in the pipeline, and you're raring to open up like the other guys are. So, what is financially? What's the biggest challenge you're going to face, you think, in the next few months?
Yeah, that's a good question. You haven't warned me about that one. I'd probably say uncertainty. Uncertainty really, in terms of trying to plan a business is organising sites, planning, licensing. It's not just like a magic formula that happens straight away. And in terms of, we've got 2 great, fantastic sites lined up, one in Manchester, one in Birmingham, and ready to go. And it's just when to press the button on that in terms of cash flow, because if this carries on for 6 months, like Boris said, that will put some pressure on, because we've signed up the leases on those, our ability to open those sites on time. And knock on for those as well is we should be starting to recruit managers on things like that. So I would say, to answer your question, it's uncertainty about timings. When are we going to get released from these measures? Just so we can start lining up the ducks in a row in terms of taking managers on, design the sites, committing builders, etc. So uncertainty.
Robin, slightly different in terms of the investment side. What are the key elements you're going to look if you're going to make some new investments in the sector? Because you just said there's opportunities out there. So what is anything that's going to hold you guys back? I think we've just lost your mic. Don't say I've silenced Robin Rowland, because that will be a first. In that case, we'll catch up with Robin. Will be providing written answers later, obviously. So thank you, Robin, for the moment. So Jane, can I move to you? And talking about your companies again, I think probably the same question I put to Martin, because at the end of the day, you've got enthusiastic teams, you've got ambitious plans. But what's the thing which, particularly from a financial point of view, could hold you guys up and perhaps, I wouldn't necessarily derail you, but certainly slow you down?
I am currently very much interested in moving the mindset from tactical firefighting into long-term strategic growth planning at the moment, and value creation. So quite rightly, we've all been fighting fires, understandably. We've been making lots of tactical decisions where strategies are changing almost on a daily, if not weekly basis. I think now's the time to take a deep breath, start planning for, what is our strategy for the next 18 months and trying to stick to it, which will require a slight change of mindset. It will require us to be a bit braver because of all the uncertainty we've talked about. But I think if we are going to take advantage of the opportunities out there, we've got to have a plan, a proper strategy plan, and lean in together to create it. And that's probably what I'll be getting my teams to focus on now.
Robin, can we hear you yet? Last chance.
Can you hear me now? I've taken the.
Absolutely. Your head. It was probably your mic on that. Yeah. So you actually have the final word now, then, Robin. So in terms of what could possibly hold you back.
What if you do be optimistic? Because there's nothing to gain by being pessimistic. I think realistic plans, well executed. Watch the cash like a hawk, but don't lose sight of the quality of a team that needs to be kept together on the other side. I think the next 6 months are going to be very telling. And really, like Jane and Martin said, I'm looking forward to 2021, where we can start seeing a rebuild going on. But it has to be on solid foundations, and a lot of hard work's gone on. Don't blow it in the next 3 months by doing silly things. And there are opportunities, no doubt, around sort of property and people, and they've been well trailed. But don't get seduced without thinking through all the consequences. But I think people should see this as a kind of starting point for rebuilding. We're not quite at the inflection point, but we're not far off.
Well, thank you all. Now, when I invited you all, I didn't expect necessarily all of you to be that optimistic, but certainly realistic. So thank you all for joining me today and sharing your views and sharing that optimism in very, very difficult times. So for now, thank you all very much. And that, ladies and gentlemen, is our last panel of the day. And I'm just going to very quickly sum up. So thank you all. Well, as I said, that was quite a session. We covered a lot of ground from our experts, market experts and advisors, through to our operators and investors. It's not going to get any easier. That's for certain. Well, that is the only certainty, because of this government, we're not entirely sure. Even now, our dear Prime Minister may be telling us something new, even in his address later today. And certainly, as Robbie alluded to, the latest numbers are not looking too healthy. But I suppose it is all about survival. You've all got your individual plans to get through. Let's hope as many of you as possible can survive, because the view back to government, and we've avoided government quite a lot today, not to press ourselves too much, is that if we don't get support, if we don't get restrictions lifted soon, we'll get back to something like a new reality of trading with certainty and some transparency. There are a lot of jobs and livelihoods on the line. As I said, survival is not going to be easy, but we wish you all a lot of luck. So another session today. We'll be more building up to our Peach 2020 session, our big day on November the 18th, when we have a bit more than a webinar with some really interesting speakers from around the globe joining us. So thank you to all our speakers today. Thank you for our partners, AlixPartners, Coffer Corporate and RSM. And most importantly, thank you to you for joining us. And just to remember, if you will be getting a copy of this recording and the presentation today. And if you want to talk, if you want more data, please come and talk to Carl and his team. But for now, thank you all very much. Good afternoon and good luck. Bye.